Can capital gains push you into a higher tax bracket? If you're earning a few $100,000 a year, bonuses are coming in, RSUs are vesting, and you're investing in taxable accounts, there's a good chance you've asked yourself this question. If I sell investments and realize capital gains, am I going to push myself into a higher tax bracket? And if that thought even crosses your mind, you're not alone, because capital gains taxes are one of the most misunderstood parts of the tax code, especially for high earners with stock compensation and large investment accounts. But here's the real question most people should be asking instead. Is avoiding capital gains taxes actually costing you more money than actually paying them? In this video, I'll show you how capital gains are actually taxed, what really happens if those gains push your income into a higher bracket, and how to manage investments and stock compensation so taxes don't stop you from using your wealth that you've already built. Before we get into the mechanics of capital gains, let me tell you about a conversation I had a few years ago with a gentleman. He had made what most investors would consider an incredible decision. He, years earlier, had bought Facebook stock when it was still Facebook and well under $100 per share. Then he did what a lot of people do. He just held it. Over time, the stock climbed higher and higher. Eventually, the position had grown so much that about 10% of the value was his original investment, and roughly 90% of the value was capital gains. Now, on paper, that sounds like a great problem to have. But in reality, it created a different kind of problem, because he became so worried about the capital gains tax that he refused to sell any of it. Those shares basically turned into what I described to him as a really awesome baseball glove sitting in the closet. Something valuable that you admire from time to time, but you never actually take outside to play. And when tax fear causes that kind of paralysis, it usually comes down to misunderstanding how capital gains and tax brackets actually work. So let's start with the basics. What capital gains actually are. Capital gains occur when you sell an investment for more than what you paid for it. That original amount you paid is called your cost basis. For example, if you bought stock for, let's say, $10,000, and years later it's worth $40,000, when you sell, the capital gain would be $30,000. That $30,000 becomes taxable income in the year the investment was sold. Now, here's where things start to get confusing for many investors. Not all capital gains are taxed the same way, and understanding the difference is really important. Short-term versus long-term capital gains. First, we have short-term capital gains. These apply to investments held for 1 year or less. Short-term gains are taxed at ordinary income rates, meaning they get stacked right on top of your salary, bonuses, and RSU income. For high earners, that often means those gains could fall into tax brackets like 32, 35, or even 37% at the federal level. So, short-term gains can absolutely feel painful. Now, compare that with long-term capital gains. These apply to investments held longer than 1 year. Long-term gains are taxed under a completely different rate structure. Generally speaking, the federal rates are 0%, 15%, or 20%, depending on your income level and your tax filing status. Most high earners end up in the 15% or 20% bracket, and in many cases, there's an additional 3.8% net investment income tax layered on top. Even with the additional tax, long-term capital gains are usually taxed much lower than ordinary income. And this distinction matters because many people assume that if they realize capital gains, those gains are going to be taxed the same way their paycheck is taxed. But that's not actually how it works. Here's where one of the biggest misconceptions come into play. A lot of people believe that if capital gains push them into a higher tax bracket, then all of their income suddenly gets taxed at that higher rate. That's not how the tax system works. Tax brackets are marginal, which means only the portion of income that crosses into the next bracket gets taxed at the higher rate. Everything below that threshold is still taxed at the lower rates. This is actually one of the most common conversations I have with clients. Someone has appreciated investments or company stock, and they're hesitant to sell because they assume the tax hit will be much larger than it actually is. But once we walk through the numbers together, the situation usually becomes a lot clearer. Now, let's walk through a situation that's actually pretty common for high earners. Imagine for a moment a household with the following income during the year. They earn $350,000 of W-2 salary. During the year, $60,000 of RSUs vest from their employer. Remember, RSUs are taxed as ordinary income when they vest, so that income also shows up on the W-2. That means their total ordinary income for the year is about $410,000 gross. Now let's say during that same year, they decide to sell some of their stock. In this example, we'll say that sale creates about $20,000 worth of short-term capital gain and about $45,000 of long-term capital gains. Let's walk through what actually happens. First, the short-term gain. Short-term gains are taxed as ordinary income, so that $20,000 from the sale of stock is added on top of their $410,000 they already earned. Their taxable income is now right around $430,000 for the year. That means the $20,000 gain is taxed at approximately the 32% marginal tax rate. Now, let's look at the long-term capital gains. That $45,000 of long-term capital gains is taxed under the long-term capital gains rate, not the ordinary income tax bracket rate. In many cases, for households in this income level, that gain will fall into roughly 15% capital gains bracket. But there's one more layer that often applies to high earner. Because their income exceeds $250,000 for the year and they are married filing jointly, the net investment income tax will also apply. This is an additional 3.8%. So when you add everything together, the $65,000 of total gains might generate roughly $15,000 of federal tax, which means after tax, they still get to keep somewhere around $49,000 of profit. And this is an important perspective shift. Yes, there still is a tax bill, but the majority of the gain is still theirs to keep. Now, let's go back to the person I mentioned earlier who had bought shares of Facebook at a really low price. The real problem in that situation wasn't the tax bill. The real problem was that fear of taxes had completely frozen the decision-making process. And I see this happen more often than people realize. Someone owns a stock that has done extremely well. Over time, that position becomes heavily appreciated, and suddenly most of the value is capital gains. At that point, many investors become afraid to touch it. They stop rebalancing, they stop diversifying, they stop using the money for goals and what actually matters, because they're focused entirely on avoiding the tax. But avoiding taxes at all costs can create two different risks. First is concentration risk. Many high earners already have significant exposure to their employer stock through RSUs, stock options, and even an employer stock purchase plan. Holding a large appreciated stock position on top of that can increase risk dramatically if that company ever underperforms. The second risk is opportunity cost, and I might say that's a bigger risk, because when appreciated assets sit untouched for years, portfolios drift away from their intended allocation. Diversification opportunities disappear, and financial goals get delayed. In many cases, paying capital gains tax is simply the cost of accessing the wealth that you've already created. Instead of avoiding capital gains entirely, the better approach is to manage it intentionally. This is where real planning comes into play. Let me give you a few examples. Investors can spread gains across multiple years instead of selling everything at once. They can use tax loss harvesting to offset gains with losses in other parts of their portfolio. They can donate highly appreciated shares to charity and avoid the capital gains altogether, and they still receive the charitable deduction. Now, they can also, and they should be doing this as a priority, coordinate investment sales with other income events like bonuses and RSU vesting. It's one of the many factors I coordinate when building a client's financial plan. When we're building an investment plan, we're not just looking at returns. We're also looking at how income, taxes, equity compensation, and investment decisions all interact with each other. Because when those pieces are coordinated well, capital gains stop being something you fear and instead become something you manage strategically. The final piece of this puzzle is portfolio discipline. Over time, different investments grow at different speeds. Some assets outperform while others lag behind. If nothing is done, the portfolio slowly drifts away from the original allocation and risk level. Rebalancing is the process of bringing the portfolio back to its intended structure. With my clients, we rebalance their portfolios periodically, often quarterly, to keep their investments aligned with their long-term objectives and risk tolerance. And when that process is done thoughtfully, we can balance investment disciplines with tax awareness. Instead of letting taxes control every decision, the goal is to manage investments in a way that support the bigger financial plan. And once you understand how capital gains actually work, the next challenge many high earners run into isn't taxes, it's lifestyle creep. Because as income grows, bigger bonuses, equity compensation, promotions, spending tends to quietly grow right alongside it. Not because someone is irresponsible, but because without a system in place, it's really easy for lifestyle to expand faster than wealth. So if you want to see how high income earners can stay in control of their money and avoid getting pulled into lifestyle creep, watch this video about budgeting for high income earners.